Welcome back to P Finance. Ever wondered what bonds are and how they work? Well, let's unravel this financial mystery. Imagine this. You have some extra money and you lend it to a friend, a corporation, or even the government. In return, they agree to pay you back with a little extra after a specific period of time. That's pretty much what a bond is. It's a loan that you, the investor, make to an organization. This loan or investment is not just out of the goodness of your heart, though. You're making this loan in exchange for interest payments over a specified term. And when that term is up, known as the bond's maturity date, you get your initial investment back. That's the repayment of principal. Bonds, my friends, are a type of fixed income security. They're one of the ways organizations raise money for various projects. So, essentially, when you buy a bond, you are lending your money to the issuer for a certain period of time. Did you know there are various types of bonds to choose from? Yes, it's a veritable smorgasbord of investment opportunities. Let's delve into this fascinating world and explore the four main types of bonds: corporate bonds, municipal bonds, treasury bonds, and foreign bonds. First up, we have corporate bonds. These are issued by companies aiming to raise capital for a variety of reasons, from funding research and development to expanding business operations. The interest rates offered on these bonds may be higher than others, reflecting the higher risk associated with corporate ventures. But remember, with great risk can come great reward, or loss. Next we have municipal bonds, often referred to as munis. These are issued by states, cities, and other local government entities to fund public projects like building schools, highways, and hospitals. The unique selling point of munis: the interest earned is often exempt from federal taxes and sometimes even state and local taxes, giving them a tax-efficient edge. Our third category is treasury bonds, or T-bonds, the safest of the bunch. These are issued by the federal government, and because they're backed by the full faith and credit of Uncle Sam, they carry virtually no risk of default. They offer lower interest rates, but for conservative investors or those seeking a safe haven in tumultuous times, T-bonds can be an attractive option. Last but not least, we have foreign bonds, issued by foreign governments. These bonds can offer higher returns, but also come with increased risk due to potential political instability and currency fluctuations. They can, however, provide a way to diversify your portfolio geographically. So there you have it. From the high-risk, high-reward world of corporate bonds to the safety of T-bonds, from the tax advantages of munis to the global opportunities of foreign bonds. These different types of bonds offer a range of options for investors with varying risk tolerances and investment objectives. So, are bonds a good investment? Well, they come with their own set of pros and cons. Let's dive into the details. One of the primary advantages of investing in bonds is the steady income they provide. When you buy a bond, you're essentially lending money to a corporation or government. In return, they promise to pay you regular interest, usually semi-annually, until the bond matures. It's like having a tenant who never fails to pay rent on time. Another advantage is that bonds tend to be less risky than stocks. The price of a bond is less likely to fluctuate wildly compared to a stock, making bonds a popular choice for conservative investors. However, it's not all sunshine and rainbows. Bonds come with their own risks. One of them is the interest rate risk. When interest rates rise, the price of existing bonds falls. That's because new bonds being issued would offer higher yields, making the older, lower-yielding bonds less attractive. Inflation risk is another drawback. If inflation rates rise, the purchasing power of the fixed interest payments from bonds declines. In other words, the money you receive in the future may not have the same value as it does today. So, while bonds can offer steady income and are generally less risky than stocks, they are not without their potential pitfalls. So, let's quickly recap what we've learned today. Bonds, essentially loans to corporations or the government, come in different flavors, each with its unique features. Government bonds are generally safer but yield less, while corporate bonds offer higher returns with more risk. There are pros and cons to investing in bonds. They can provide steady income and diversification, yet they are not without risks, such as interest rate and credit risk. Remember, bonds can be a valuable component of a diversified investment portfolio, but it's important to understand what they are, their different types, and their potential benefits and drawbacks before you invest. Thanks for sticking with us till the end of this video. We hope you found this information on bonds useful and enlightening. If you did, don't forget to hit the subscribe button and give this video a thumbs up. Your support allows us to continue providing quality financial education content. And remember, knowledge is power, especially when it comes to your finances. Stay tuned for more videos where we break down complex financial topics into easy-to-understand language. Until then, keep investing wisely and stay financially empowered. P Finance, empowering your finances $1 at a time.